Hello and welcome to our special pre-budget series, Mapping the Stimulus. This budget comes on the heels of an unprecedented demonetization and the widespread expectation that the budget will provide some salve, some stimulus in some fashion. Is there a need for a stimulus? How much and in what fashion? That's the question we are asking in the first of this three-part series. First, we want to set out the hard numbers, and hence we kick off the series with two very thorough economists. Joining me now are Sajid Chenoy of JP Morgan and A. Prasanna of ICICI Securities PD. Men who have done the numbers, they will lay out and then we will fill in and see how much the budget will deliver and how much the budget can deliver. Prasanna and Sajid, thank you very much for joining me. Well, first up, Prasanna, let me start with the current year itself. Is the government expected to over-deliver on its fiscal deficit simply because you've got the IDS and perhaps high excise on fuel?
Yeah, so as of now, the numbers, what we are looking at, they're tracking a 3.5% fiscal deficit, which should be in line with their target. But yeah, potentially it's possible because we don't know how much is going to come from IDS2. In fact, we don't even know how much is going to come this year and whether there could be some spillovers into next year. Yeah, but so the likelihood is there that they could over-deliver on this year's target itself. But perhaps we are looking at 0.1 to 0.2% of improvement, not more than that.
So you mean the fiscal deficit could be 3.4%?
That's right, yeah.
Okay. Will you also assume that next year the government will be able to deliver a higher than trend tax revenue collection, in the sense direct tax revenue collection, simply because a little more has come into the formal economy?
So that is very difficult to kind of gauge at this point of time. Obviously, we don't know how much of these trends are sustainable. But the broader sense we have is that it's going to be very difficult for tax revenues to, I mean, we're talking about overall tax collections, for the growth to even cross into double digits into next year. We should remember for the last 2 years, there's been a huge windfall on indirect taxes because of high excise duties on petrol products, as well as the increase in service tax. So this year, abstracting from GST for the time being, if you look at it on assets various basis, definitely tax growth is going to slow down. And direct tax, I think we have to remember that at some point of time, government has to reward taxpayers also. So obviously there is a cut in corporate tax which is already pending, and I would not be surprised if they try and give some rebate to income tax payers also, whether in terms of whether it's a permanent cut or a one-time rebate. So in that sense, our baseline assumption is for next year, the tax growth will be in single digits. Now, on top of that, now we have to look at how GST kind of affects that. But abstracting from GST, we are looking at a slowdown in tax revenues.
Sajid, to you on that, what will your assumptions be in terms of next year's direct tax revenue growth? I'm assuming that at the moment the government will not touch indirect taxes in this budget.
But I broadly concur with what Prasanna is saying. Essentially, there are a lot of moving pieces here. One is going to be, what's going to happen to nominal GDP itself next year. If this year nominal GDP is lower and you get some sort of rebound in consumption or activity, then what does that do to tax buoyancy? That's the first point. The second is we have to see also on direct taxes, to the extent that corporate tax rates do come down, as the finance minister has indicated, which exemptions are we closing so that, whether it's revenue neutral or not for the government. And the third is that, as oil prices continue to go up, there has to be the recognition that indirect taxes have over-delivered the last few years because tax rates have gone up, both service taxes and indirect taxes. So my sense is that indirect taxes will grow less than nominal GDP, and that ratio may go down, and therefore this will all come down to direct taxes. And your first point, which is how much extra tax revenue does the government expect to collect from all these 15 trillion of deposits that are in the banking system, that becomes the key in terms of what you see for taxes next year. But I think, going forward, keep an eye very closely on nominal GDP. If nominal GDP were to disappoint next year, then the tax buoyancy that is typically associated with a dip in growth could be troubling for the government. If in fact you see that, as the currency situation normalizes and much of the consumption that was delayed from this year rebounds into next fiscal year, then in fact you could have an upside surprise to nominal GDP and therefore to tax buoyancy.
Okay, well, I'm still not coming to the elephant in the room of the FRBM and what it might suggest, because we don't know. Let me still persist with the growth numbers. Prasanna, what are you assuming in terms of real GDP, nominal GDP growth, on which you're basing your tax revenue, and what is your tax revenue growth number?
So next year we're looking at a nominal GDP growth of around 11.5%, broadly based on 7% real and 4.5% nominal. In terms of tax revenue growth, ours is slightly shy of 10%. It's around 9.5%. That's overall tax numbers. And I think it is broadly similar numbers for both direct taxes and indirect taxes. Now, of course, indirect taxes, if you assume GST gets introduced fairly early in the year, then we are building in actually a sharper rise in indirect taxes, and therefore the overall tax growth also picks up to around 14.5%.
Okay. Well, now to the key question that the budget will have to address, Sajid, is there a case for reneging on the fiscal deficit timetable? At the moment, we don't have a timetable because the Kelkar committee has been replaced by the encasing FRBM committee, which perhaps will not place its recommendations in the public domain at all, from what we learned from the committee. But should 3.5 be allowed to remain at 3.5? Should it be allowed to go to 3.6 simply because we are coming on the heels of demonetization?
But I don't see any case for a stimulus here. You know, what's strange, the debate has changed. Last year the debate was, you know, to what extent should the government consolidate its finances. This year the debate seems to be, is there room for a stimulus? I think absolutely not, for multiple reasons. First is, let's appreciate the fact that with the bulk of deposits coming back in, this is not an enduring wealth shock that we had feared on the morning of November 9th. This is a 2 to 3 quarter liquidity shock. And with every passing week of the economy getting demonetized, our senses, growth will begin to recover. So this is a temporary shock that should be, largely done by the time the first quarter of next fiscal year starts. So the first point is, why would you want a fiscal stimulus for 4 quarters in 2017-18, wherein by the first quarter of the next fiscal year, activity should be beginning to mean revert.
Well, Sajid, I'll just come back to you in a minute. Let me get Prasanna as well on the issue. Prasanna, what is your sense? Is there a case for fiscal stimulus? I mean, is there a case for the fiscal deficit going above 3.5%?
No, we don't think there is a case. I think what we are looking at is we are still looking at 3% for next year as per the earlier roadmap as one of the guideposts. And what we are saying is going from 3.5 to 3% is going to be very, very difficult in our base case. So government shouldn't force the issue. I think that is a limited point we are making. So perhaps if they land up somewhere at 3.3% or something like that, heavens won't fall. I think that is the argument we are making. And the second point I want to make is, in any case, if you assume GST is going to be introduced, there's going to be a lot of uncertainty about the kind of collections we're going to get. Plus, there's a huge issue of compensation to states, and this is related to the earlier point Sajid made about nominal growth. Now, government has promised states on a normative basis of 14% growth, right? That's the compensation calculation.
Yes.
And if nominal growth were to slow down, the government will find itself in a sticky wicket. So our point is, don't force the issue from 3.5 to 3%. Be a bit more relaxed next year, and then get back to the path the year after that. That is the limited point we are making.
What about you, Sajid? Prasanna's point is that there's no question of going from 3.5 to 3.6, but also no case for forcing the Kelkar timetable of 3%. Why not 3.3? What would be a number that you would be comfortable with on fiscal deficit?
So I broadly agree. As I was saying earlier, I think the fact that this shock is temporary, the fact that monetary conditions are easy, and the fact that state fiscal deficits have widened very sharply, have deteriorated, suggests that there's no case here for a large stimulus. But it's understandable that given where cyclical conditions are, I mean, appreciate the fact that even before demonetization, GDP growth in the first half had slowed to about 7.2%.
Yes.
If the pace of fiscal consolidation were to gradually slow, and the government were to target 3.2 or 3.3, I'm not sure the world would fall down. In fact, if you ask me, bond yields already pricing in some degree of a relaxation of the path, and people will be okay, I think, with the 3.2 or 3.3. I think, and then resuming the path next year. I think what's dangerous is to entertain any thoughts of a stimulus above 3.5, given all these other factors.
Okay. Well, then, Prasanna, if the widespread demand of demand for a cut in personal income tax or corporate income tax is granted, then do you think the government will be able to manage everything, give a little bit of cut as well as manage the fisc at 3.3, or will it renege?
I think it should be possible. I mean, our tax numbers, for example, already build in some tax rebate on income tax front, and of course, corporate tax. I think it's a bit more difficult to guess because they're simultaneously going to phase out exemptions also. So we don't know what is the net tax impact is going to be. But yes, so I think the key is on the expenditure side. If the government just sticks to whatever it's already announced on December 31st by the Prime Minister, and as well as there's going to be some higher salary component because of allowances, and beyond that, if you're not looking at too much of expenditure increase, then it should be possible. And we have to remember, I think, from this year itself already, if you look at the year-to-date spending pattern, as it is on a capital spending side, I think the government is going slow. So maybe there is a possibility that they are not able to spend what they have budgeted. So in that sense, I'm not sure how much of a step up in, say, investment spending or infrastructure spending really the government can commit to and deliver into next year.
Okay. So, Sajid, no Santa Claus budget for taxpayers, no Robin Hood budget for the poor would be your desire?
The desire would be, listen, I can understand why the government would, if consumption has taken a big hit in the last 2 quarters, why there'd be some pressure on the government to try and offset that. So, some tax relief for the low end, some expenditure for welfare programs to create safety nets is understandable. But my 2 large principles here is, I think, not to abandon the path of fiscal consolidation. If you slow the pace, given where cyclical conditions are, that's understandable. And number 2, I still continue to believe that the problem in India is not consumption, it's investment. If you look at the 4 quarters before demonetization, consumption was growing at 8%. Investment was contracting at 2.5%. So I actually think whatever resources the government gets from demonetization, from these deposits, that the focus needs to be on public investment, as it has been the last 2 years. I would much rather see more expenditure devoted to those areas. I agree with Prasanna that there is an absorptive capacity issue in terms of spending, but that's not something that's insurmountable. So I want to just summarize by saying that let's also not forget the reason it's so important that they stay on a consolidation path is there are multiple other stimuluses in the system that we don't talk about. State fiscal deficits have widened by 1% of GDP in the last 2 years, and monetary conditions are at a 2.5-year low. So the economy is already getting some support. That's why it's important from the centre's perspective to keep chipping away, even if it's at a slow pace, at their fiscal consolidation. But otherwise, my worry is much of the rally you've seen in bond yields may begin to reverse, especially given what's happened globally.
Right. Gentlemen, thank you very much for joining me. Key takeaways from our first discussion on mapping the stimulus. Don't be under the impression that you should give a large stimulus to the economy. Fiscal deficit direction should still be maintained, and the deficit should be aimed at 3.2 or 3.3% of the GDP. We'll take a break on that note. After this, we will be joined by Ratin Roy of NIPFT.